to all of those who came along to our meetup last night. It was really good. Talked for about 2 hours together across a range of different ideas. But because it was such a long, drawn out session, well, a very interesting drawn out session, including a lot of general chit chat, I thought I'd just sum up what we talked about because I thought it was really interesting. And I know some of you couldn't come for various reasons, so I thought I'd produce this video. So I think the essential points we talked about were keeping things simple, fine. I personally like really clean charts and fibs and Elliott wave. Other members put a lot more emphasis on moving averages, which is fine. I don't have a problem with that. Moving averages are very useful. But the overriding thing was just that it was important that you understood what sort of trading style suited you. You kept things very simple, and you did. And my sort of message to everybody out there is just make sure you do a lot of preparation, and you have a trading plan that works, and that you can works from the point of view that it's simple enough for you to follow every day. And so I'll be doing a special one for Scalper School graduates on Monday. More information about that. Anybody who's been a Scalper School graduate, I will invite you in to give you a better update on what's going on as far as days trading is concerned, and what I think you can do to dramatically increase your probability of winning every day, getting income every single day. That's the aim. And so I want to give you some follow through on the program that you've been on, and try and improve your probability. Okay, so here we are with the daily Dow. So what I would do with a chart like this is throw the fibs on. Now this is why I prefer the fibs to the moving averages, because if I take these little trend lines off and then start zoning in on what we're seeing, so here's the initial move, bang, that's the high and the low from the excesses of this market that just popped up with very little pause. If you look at the weekly time frame with any indicator like stochastics, RSI, MACD, whatever you like, this was bubble territory. So we formed a top on literally last Friday in January, and the following Monday we didn't engulf it, but we certainly closed lower. Had a decent follow through on the 30th of January, paused, and then we got this huge, the market just capitulated, just pulled the plug. So what do you do in a situation like that? Well, for me personally, I would throw my fibs on it and then start zoning it. So you've got the inner zone here and the outer fib zone here. So what happened? Well, after we created this bottom on the 6th of Feb, how do you know it's a bottom? Well, it closed higher. That's one clue. And if you start to fib it from the high and the low, you can see if the fib fits, then use it. For example, this bar here sat right in the middle of this zone. Actually didn't. It sat mainly in the inner zone, but the lower part of the body was in the outer zone. But anyway, the point is it fits, and you got a higher close on one day, suggesting that all the selling was at that point temporarily finished. Then you started getting a little hammer-like bar here. So no more sellers came in, the buyers started taking over, and we saw a move into the top of this zone, a 61.8% zone. Bears got hold of it, dragged it down for a few days, and we popped up. When we did pop up, we only popped up to this top of this zone. Very next day sold, broke through the 50% into the bottom of the zone. So another way that what I would add to this equation to make this much more relevant to me, I would count the waves, and just look at the impact of Elliott wave on this. So that's wave 1. That's the huge amount of fear crept in and the market capitulated. You could argue that was wave 2, retracement to inner zone. Wave 3 almost got down as far as the low. 4 took us back to the top of the zone, and 5 took us just under the 50%. Okay, so that's your 5-wave move. So I'll mark that with a divide line, and then you tend to get a 3-wave correction. So 1, 2, 3. Mark the 3rd wave. Now at that point you're basically back to the original trend. So the original move was the downside. You've had a 5 and 3 wave move, so Elliott wave fans would expect that to start to come down again. So wave 1, wave 2, wave 3, wave 4, wave 5. So another 5 wave completed. So then you get a 1, 2, 3, 4, 5. So we could have potentially completed a wave 5 move here. And we literally just closed above this 23,935 yesterday. So in theory, we're in for a 3-wave correction. So assuming we are pushing up on the back of this higher close, let's say we get a 1, 2, 3. So if we end up here in sort of June, July, then I would look to get short at 25,800. It's possible it could go all the way back to the highs, but at this stage I would suggest that in the coming few weeks we may see 25,285, retracement back down to 24,470, and push back higher. I mean, we have been very bearish, very bearish. So I'm going to take a lot of this off because it's just going to make a lot of noise. In fact, let me take the whole thing off. I'll leave the wave dividers in for now. Okay, and I'm going to put the fibs right back on this. Non-farm payrolls out in an hour and a half, by the way. Okay, so looking to see if, in fact, I'm going to take this off, and what I'm going to do instead is I'm just going to zone it for now. So assuming we're going to punch higher, I'm not going to roll over. Actually, I can't see that bar properly, so I'll have to take that off. Okay, I'll take that off. Assuming we're going to punch higher and not roll over, bear in mind we have got, if you're a moving average fan, we've got a 50 and a 200-day average coming together. So we've definitely got, we should have a decision on our hands as to which way this market wants to go. So if the market decides to push higher, then we need to see if we can close above 24,490. just a tad under the big 25,000. Close under the big 25,000 and we might well head back to one of these zones, either that one or that one. I'll step them so we can differentiate them. Okay, to do that, to have any chance of doing that, we need to close above that little trend line, and obviously close above that as well. So we're in an apex of the triangle, looking to see if we can punch higher. Now if we bump into that 24,000 and or a little higher, 24,200, and can't survive, then we'll potentially come back down to the lows. Who knows, maybe even down to this area here. Okay, so that was a lot of what we talked about last night. Just this is my way of making sense of the market. This is my way of coding the market. Other people, other traders in the room liked the moving averages. So this is the weekly chart with the 50 and the 200, and you can see we've not made contact with the 200-day average, so the 50-day average. So if you're sitting here thinking this market's really bullish, we've turned because of yesterday's bar, well, just bear in mind that markets love to come in contact with these. You can see before we had this big long breakout, we had two touches at this area here. We came off the 200-day average in 2016, and then we did a nice wave. We did so wave 1, 2, 3, 4, 5, 1, 2, 3, 1, 2, 3, 4, 5, and then we just blew up. We just broke. Okay, so we are potentially in wave 2 of a correction, heading up potentially. And obviously, this is the weekly bar. Here we are on Friday. Euro session has been and gone. US session's not far off. We're not far on payroll, and here we are, third week in a row with a red lower close. So this is why you've got to be very cautious about any thoughts about going long, because this market is only just trying to recover, and that's not completed a complete three-wave move or a test of the 50-day average. Okay, so let's see what we get, but at the moment the bears are very much in control. The bulls did drag this up and we achieved a higher close on the daily chart, but it's all there to be had. Let's just copy that. Oops, that's no good, is it? Right, I'll do this. I do that line, cancel that one, copy that one, and then drag that down there, cancel that. So we are very close to coming to the bottom of the channel. Very, very close. We may just need a bit more of a dip, but it's all to do today. So if you follow that through with the DAX, now the DAX did not get as hyped, and the advantage the DAX has got over the Dow is the fact that the euro, the DAX has benefited from a cheap euro, a cheap currency. and at the moment the dollar is strong, which is putting a lot of, amongst other things, other issues, putting a lot of pressure on their exports. Okay, so this DAX needs to close above 12,700 minimum for my money. Otherwise, again, if you're a moving average fan, if that we close underneath that 50, then we could come back to see this test this triangle again, this trend line. Sorry. Right, so this is look at this. This is how 1, 2, 3, 4, 5. This is the 6th week in a row at the moment with a higher close. A couple of 2 or 3 of those bars are really flat. But yeah, at the moment this is looking like a very bullish chart. The last time we were this bullish was here, and we ultimately held the channel here until had a nice close up, and then they just slammed it down. Let's keep it simple. Alright, so this is a massive area. All this resistance up here from May 17. Interesting that as this time last year we were up here. So again, another word of caution. This is a huge area of resistance with the DAX, and if we start to fail here, we could tumble right the way back down to 18 lows if this really rolls over big time. Alright, so that's a lot of what we went through. More dates will be coming up, but for members of Trade the Easy Way, I'll put together a few events this weekend and give you the dates for other big picture work and scalper school updates. Alright, let's see what non-farm payroll gives us and talk to you later. Thanks for listening and bye for now.